we are only in the third inning here, right? And I strongly believe this. And you probably saw a couple months ago, BlackRock wrote the article that this space is going to be 600 billion by 2030. These types of investments aren't in the get rich game. They're in the stay rich game. What happened in 2022? Stocks and bonds both went down at the same time, right? Because why? Rates went up, stocks and bonds both went down. Now, you could have mixed stocks and bonds in any combination, you were down. So if you actually look at the numbers, you're like, this is actually the compounding effect of winning without losing, right? Because you had more to invest to take advantage of the gains in 2023, 2024 in the first half of this year. Though that's the key is the ability to play offense and defense at the same time.
Jeff, thank you very much for joining us and welcome to Excess Returns.
Yeah, thanks for having me, Justin Jack. Great to be here.
Today, we wanted to talk to you about the investment strategies that you've built at Vest Financial and some unique qualities that go into them. Specifically, you guys run a series of defined outcome investment strategies. Some of the strategies aim to provide downside protection while still allowing for upside participation, while others are more focused on growth or income-focused outcomes. And these types of defined outcome strategies have grown significantly over the past few years. I think, and you can maybe correct me if I'm wrong here, I think Vest now either sub-advises or advises on over 40 billion in assets, which is pretty impressive and awesome for you guys. And so, today what we want to do is just kind of explore what makes these strategies compelling for investors and advisors, those using them, kind of look under the hood at what makes them work and sort of get your sense about where the space is evolving and where some of the innovation is happening with these defined outcome strategies. And for people that are listening to this, you can learn more about Vest Financial. The actual URL is vestfin.com. And, you guys have plenty of content on there about the strategies themselves and the different types of vehicles that you're deploying them in. So really, thanks for joining us. This is going to be good.
Yeah, absolutely.
Where did the idea of Vest come from? I know that I think I have the timeline. I think there was a patent in 2012, which is pretty amazing when you think about that. I believe you guys were part of the 2015 Y Combinator vintage in terms of businesses that are kind of being innovated and come out. So just maybe give us a little bit background on the idea and the history. I think that's a good place to start.
Sure. And this kind of comes into kind of the genesis and kind of fits in the overarching story that if you look at like buffers as a strategy, right? They've been around for over 30 years in structured note form. I think in buffer annuities launched in 2010. I think last year, just in buffer annuities alone, there was almost 50 billion in new sales last year. So I think what a lot of people are seeing the growth, they're just seeing it in the fund space, right? That these strategies have been around since like when the first structured note, launched in Europe. These were, and buffer strategies have been, one of the few evergreen strategies in the structured note space. And why I set this up that way, and even before then, is even in the structured note, if I take it back, it's a put spread collar in option strategies, which people that are not familiar with options, meaning that strategy has been around even since, options had really been put out. So it's not that we invented anything, particularly massively new from a strategy perspective, because hedging has been around for decades, right? Now, what makes it so unique inside fund form and what kind of spawned the idea of doing it was post-Lehman collapse. So I was an option trader. My co-founder was a structurer at a bank. So we both used to work at banks, really playing our part in building these types of strategies for banks, right? And then obviously the Lehman collapse occurred. And the thing was that most people don't know the largest issuer of structured notes in 2008, take a guess, Lehman Brothers. And people didn't realize that they were while they thought they had protection, but that protection is only good as the unsecured debt borrowing that the note actually represents, right? Meaning the bank defaults, you're essentially in bankruptcy court. And then I remember, and it was like in 2011, someone stood up at a conference. I think it was at one of the banks that did an industry open challenge that anybody that solves the credit risk in these types of products will have changed the industry. And as a naive young 30-year-old, I was like, challenge accepted. And me and my co-founder Kron were like, hey, all right, let's go figure this out. Right. And so we just started thinking about like, hey, what are ways to be able to kind of not have the credit component and increase the liquidity. The idea is that like in most cases, if I were to issue a note as a bank, I would hedge the position with options on the back and I would issue a promise, right? It's an easy way to raise debt. Now, instead of having the bank hedge themselves, what if I just put the options in a fund, the hedge inside a fund? Now you own the hedge. Essentially, I've cut the bank out in the middle, right? That we can just put it in there for you. Now you actually own the exchange traded options, then actually deliver the outcome. That was actually, so if you really think about it, the genesis and the impetus of actually going was actually the Lehman collapse, that to solve the credit component, right? And a lot of people are like, oh, the credit doesn't matter. Well, if you look a couple of years ago, Credit Suisse almost went bankrupt until UBS bailed them out, right? And those are kind of the concerns that we really sought out to solve. And that's what kind of spawned us to file the first option-based kind of target outcome fund back in 2012. We launched the first buffer fund back in 2016. That kind of kicked off this whole thing. And this is also what attracted one of our largest investors, Siebel Global Markets, the Chicago Board of Option Exchange, because they really saw that this could really change the industry on bringing the benefits of exchange traded options in the structured space, right? Like in notes and like what we see in other types. Because the other component is like a lot of people ask, well, why don't they just trade the options themselves, right? And in fact, Cerulli Associates did a survey. They went out and polled financial advisors. They asked them, hey, why don't you hedge using options? By the way, they came back, everybody said the same two things. You know what they said? Number one reason was compliance. The compliance burden associated with trading options. You know what number two was? Scalability. Why scalability? Because when you buy an option, annuity, a structured note, they all expire, right? You have to trade it over and over again. So like every 30 days, 60 days. So how do you scale that as an investor, that you have to then trade it for yourself or every single one of your clients every time those options expire? But by having it inside a fund, we trade the options for the investor. And there's obviously additional benefits to that, whether it be tax, liquidity, credit. So there's a lot of things solved, but it solves a lot of the issues that, this trade, a put spread collar or a structured note or an annuity, a lot of the issues that people have seen before really get mitigated in the fund form. And what are those? Liquidity, credit risk, scalability, the ability to asset allocate now. So this is where where I say like, hey, it's not anything new. What it is that we made it easy for people to be able to access these strategies without some of the downsides. And I always like to tell this interesting story of like, hey, what does it actually do? Is that, so, Thaler won the Nobel Prize in economics for behavioral finance for the nudge. And if you guys are familiar with that, one of the initial studies was actually done by Cornell University, where they gave students free apples in the lunch line. And like very few kids took one. By the way, they're free, right? Then they cut the apples up, like slice them and put them in bags. And the consumption went up past 85%. By the way, it was like less than 20 and it went to 85% consumption. Same apple. What happened? They cut it and put it into bags, made it easier for them to eat. And this is the idea of the nudge, is that like, there's massive benefits with hedging, right? How do I make it easy for an investor to be able to hedge in almost like a bag package solution without, let's say, having to go through a bank, without having to go through an annuity company? I can now have intraday liquidity and all of those benefits associated. So that really is like, we can come back to the idea like, hey, we're making that hedging part much, much easier. We're not reinventing the strategy. We're not inventing the strategy itself. We're just reinventing it to make it easier. We're bagging the apple.
Yeah. And I think in terms of the bag, the ETF sort of structure is what coincided with, after the Lehman collapse, sort of this idea, but then ETFs obviously have become massively popular with advisors, with individuals. And so those two things kind of match up. And you don't run only these in ETFs, but obviously the ETF business is an important part of it.
Everything is a different bag for the investor to make it easier, right? And Because that is, they know they want the benefit. They're like, apples are good for me, but it's hard for me to access, right? For one reason or another.
So if you were describing like a buffer ETF
Mhm.
strategy in simple terms to a new investor, how would you describe that to someone?
Yeah. So several things from a high level. I can first explain the what. What is it? So typically buffer funds are a fund that they don't expire, but over a term, typically 1 year. Let's say you have a buffer protection where it protects the first, let's say 15%, right? So if the underlying, let's say S&P is down 15, you'd be flat in the strategy. So, and if it's down 16, you'd be down 1%. So you're protecting the first downside. Now, this is what makes it a buffer. And then you get upside up to, let's say 15% up to a cap, right? So if S&P is up 15, you're up 15. If it's up 20, you're up 15. Now that's how you're paying for the protection, is the capped upside, right? To the buffer. What makes buffers unique though, why we call them buffers, is because they protect the first 10 or the first 15. I, I get a lot of questions on why not protect everything past 10, right? Meaning, that sounds like a great sales pitch. Like, you cannot this year lose more than 10%, right? The problem is if you actually test that over the long term, it massively underperforms, because it's like buying a high deductible insurance policy, right? That you're buying protection you're not frequently using. Whereas if you're buying the first 10, if you actually look at the 1 year point to point and you have rolling days as far as S&P drawdown, over 70%, in some cases, how you do the math, over 80%, when the S&P draws down, it draws down between 0 and 15. By the way, if you take away '08, right? You take away the Fed put of '08, you're talking about almost 90% of observations are between the 0 and 15 mark, right? Outside of crisis. So then you ask yourself, what kind of insurance do I want to buy? Do I want to buy everything past 10 or 15, or do I want to protect the first 15? Because typically you want to buy what? Insurance that is actually going to pay, right? As opposed to high deductible. That's what makes buffers unique, is you're buying the protection that is more frequently used. So even if you measure like a normal distribution of S&P, you're protecting that higher observation, the higher probability observations on the down market, and you're participating in the higher probability observations on the upswing as well. And that's what makes kind of buffers unique. Now, the actual so that's kind of what it is. Now, ask yourself, like the question then comes next, like, why does this matter, right? And why has there been so much growth? Because here's the thing, like I have like a lot of young people that ask, they're like, hey, you manage 52 billion, like what ETFs should I buy? They're like 20 years old, like, and they're just starting out work. Like, the idea is these types of investments aren't in the get rich game. They're in the stay rich game, right? Most financial advisors are in the stay rich game. This is why their clients have financial advisors, right? Because think about it. People that have wealth, they just don't want to be poor. The idea of a buffer is to keep people rich, not to get rich. Like I always tell people that, like, hey, if you're trying to get rich, I don't know, go buy like crypto, go buy like, things that are going to go skyrocket. If they want to get rich, the idea is if you want to stay rich and you want to just be like, hey, you know what, protect the wealth that I have, but make a reasonable return. Let's say, 12, 18%, depending on the buffer that you look at. Most, like I said, most people want to protect their wealth, especially in the financial advisor space, as opposed to getting rich and getting outsized returns, right? Like 50, 70% returns. That's not really what they're looking for. They're looking for that protection.
So you think these are more widely used than by people more towards retirement? Like I think about sequence of returns risk,
Sure.
and I think about what you were saying there. Like, is that the primary user of this type of thing?
Yeah, I mean, there's always been like, people writing about it. It's like boomer candy, right? Which I disagree with, only because my client base is all over the place. Like if you look at a 10 buffer on S&P, right? And CBO has an index on it. If you look at that index, the standard deviation is not too far away from, a 60/40 portfolio, right? You compare your standard 60/40 indexes, the vol standard deviation, very close to that. So then you think about who's appropriate for a 60-40 portfolio, right? That's kind of run of the mill in the middle. And that allows for people to an alternative to just straight 60-40. And this brings me to the point of why. Another thing is like, why has it been so popular? Why are people actually introducing buffers into their portfolio? Is if you think about it, unless you were managing money 40 years ago, you are not managing money during times of inflation, right? Think about that for a moment. And the only time you experience it is in 2022. And what happened in 2022? Stocks and bonds both went down at the same time, right? Because why? Rates went up, stocks and bonds both went down. Now, you could have mixed stocks and bonds in any combination, you were down, right? And so I always ask like clients, like, what in your client's portfolio is going to save them if 2022 resurfaces and inflation occurs again? Because stocks and bonds were both down. You were like Tom Brady choosing between alimony and child support while taking your kid to jiu-jitsu practice, right? Like you couldn't, like there was nothing you could have done outside of hedging. And this is why we say, why not diversify your risk management and just hedge, right? Because the great thing about hedging is that put is perfectly negatively correlated to S&P, right? That once it crosses its strike, it pays you 1-to-1. There is no idea that like, hey, I hope when my stocks go down, my bonds go up. In the case of hedging, that is a set negative correlation in that zone that you're actually. So this is why a lot of people that have used buffer strategies in the last couple of years, if you actually look and you looked at it, outperformed 60-40 in some cases by double digits. Why? Not because of what you think. It's because in 2022, if you did not participate in the majority of the drawdowns in 2022, you had more to invest to take advantage of the gains in 2023 and 2024. So if you actually look at the numbers, you're like, this is actually the compounding effect of winning without losing, right? Because you had more to invest to take advantage of the gains in 2023, 2024 in the first half of this year. Though that's the key is the ability to play offense and defense at the same time and diversify the way you risk manage. Because the question becomes is like hedge funds, institutionals, they're hedging. They have the scalability to be able to trade the options. They have the scalability to be able to hedge, right? But it's much more difficult in a portfolio if I got to do that for every single one of my clients or even for myself. By having it in a fund, now the hedge is actually built in. It's solved the compliance, solved the scalability. Now I can really diversify my risk management and not necessarily just depend upon asset allocation diversification as the source of my risk management.
If investors buy a buffer ETF and then looking out a year, does that fund then still continue to exist, or do they have to repurchase?
No,
they don't need just this continuation. Okay.
That's a good question. So the buffer ETF doesn't expire at every 1 year part. So that's why many of the buffer strategies are monthly, right? So if you buy, let's say the September one, it resets every September. Now the reset gives you a new buffer. So if you bought, let's say the strategy of a 15 buffer, that 15 will reset to 15 and then give you another 15 buffer. And then it's just like an ETF rebalance. It doesn't expire, but let's say in the previous period, you put in $100 and went to 110. That 15 buffer is on your 110. It's not only protecting your original amount, but also protecting the gains that you've made. And this is a lot of times what we've been talking about is the key here is thinking about when is the best time to buy protection? When markets are near all-time highs or they've already corrected down 25. You definitely don't buy flood insurance after flood. You definitely don't buy fire insurance after the fire. I know. I'm from LA, right? Like, the best time is when you're at all-time highs. Because think about it, with the PE ratios of where the S&P is now, a lot of the gains, depending on how you look at it, is already baked into price. Why not protect those gains, right? Why not protect those gains? And then if you're wrong, you still get double-digit returns, 12, 13% returns to the upside, right? Like I'd give my first-born child for 12% return for 1 year from now. I think most people would, like given where other returns are at in other asset classes.
So the idea is on the day this is set, I know what my buffer and I know what my cap is. Then if I acquire it somewhere in that next year, those are going to change slightly, right, over time or significantly, depending on what happens. Is that right?
Yeah. So obviously for a particular buffer ETF, if you buy it after the reset date, the terms might have changed. But this is what the great thing about technology is, with our partners at First Trust, we built technology where investors can actually just go on our website and say like, hey, if I'm going to buy the July one, which by the way is our July strategy that's already fired off. If I look at the July strategy, I can see exactly if I buy it, if I invest in a particular strategy right now, what is its upside? What's its downside? If I got in right now, up to, I think like it's like a 10-minute delay. So it may not be perfectly of what you want, but you know the terms, because the great thing about options is just math, right?
Right.
I can tell you to the penny what you're going to get at the end of the target outcome period, vis-a-vis what the option strikes will be. Obviously if we, the securities that were traded, will deliver those. And by the way, that is a key point that I will make, is that what differentiates one buffer provider from another, right? I get that question a lot. Now, if you think about a buffer strategy, you can choose anywhere 10, 25, 100. Like, so the performance is largely the choice you've made as far as what level of protection you've taken, right? But what's on us as the manager, though, is that if we tell you you have a 15 buffer and a 15 cap, our responsibility is to deliver the terms of that. That is the most important thing, right? Just like a note or an annuity is a promise from a bank, right? They have to deliver it, otherwise they're a default. A fund is different. You'll notice every prospectus says we seek to deliver that buffer. We seek to deliver that cap. So it's up to us to trade the securities that actually will deliver those outcomes.
What is the range of strategies here? You mentioned a 10% buffer or 15% buffer. Like, what is the range of buffers that are offered like across the whole product suite? And what is the range of caps?
That's a good question. So the buffers are typically the standard, meaning like a particular strategy will say what buffer it is, 10, let's say 10 buffer, or 15, 25, all the way up to 100, right? Or in our case, we talk about a max buffer strategy. So the caps vary with primarily, they vary primarily through volatility in interest rates, meaning the 1-year volatility as well as the 1-year interest rate. Other things that can affect also dividend yield of the underlying volatility skew. There's a lot of other things, but let's keep it simple as far as for the listeners that it's primarily volatility and interest rates. So as volatility and interest rates go up, the higher the cap would be. So if I have a 15 buffer and let's say higher vol, higher cap, higher vol, higher interest rates, you're talking about the cap you would anticipate to be higher, right? And those things can range, right? Like typically anywhere from, let's say 7% in our strategies, let's say 7% upwards of, in some cases, it could even get up to 30%, depending on where vol and interest rates will be. We primarily targeted our strategies to have a lower bound of the cap of 6 to 7%. That's when like vol, like let's say VIX goes to 9, rates go to 0, right? Because the long-term average of equity returns are typically higher single digits, right? This is where I think it's for investors is critical to understand and to look at the strategy. So like there are certain strategies out there not managed by us that in certain environments, the cap would be 0, right? And this is where investors need to be careful when they're looking at the strategy price in every environment to understand that, hey, you don't want to be there one day that rates fall, volatility falls, your cap goes to 0. Now you have a strategy in your portfolio that has a 100% chance of losing money because it's just a fee, right?
So back to your original point, like if I'm going to do a 15% buffer ETF, what that cap is going to be is different every year or every month because it's determined by market conditions, what that cap is based on what's going on right now. Is that right?
That's right. And then higher rates, higher volatility tends to lead to higher caps in most strategies. Yeah, most buffer strategies.
And to your earlier point about like, you can't obviously protect all the losses, I assume there's a certain like maximum buffer you would want to offer based on what's going on, right? You wouldn't want to have like a 50% buffer or something like that, right?
I think the key here is you don't want a static 50.
Okay.
Right? The reason why a 50 would probably price right now. So it's good, right? But then if vol falls, interest rates fall, and we get an environment like 2017, 2018, then that strategy is going to have very low to zero cap. Then the question becomes so you have to design the strategy to be more reactive if you're seeking to have a higher level of protection. That's what we've done, is because we don't want somebody to get into a 100 or a 50 and end up not in a good spot, right? There has to be a moving piece to be responsive to pricing. I think that's critical. If you're talking about strategies with deeper levels of protection, because they won't always price.
What's your experience in terms of which ones of these are most popular? I'm curious, like which buffers are most popular in terms of, you have a lot of experience now with investors using these. Like which ones do get used the most?
Our 10s and 15s, like 10 protecting the first 10, protecting the first 15, and then probably our 25, which is you take the first 5, the next 25 is protected. Those are probably our 3 most popular strategies.
So as you could probably tell from talking to me so far, I'm a pretty nerdy guy and we have a pretty nerdy audience. So I wanted to go back to what you talked about before in terms of the actual option strategies behind this. Can you just talk about like what the option strategies are sitting behind the scenes that allows this to happen?
Sure. So there are actually many different ways to construct a buffer strategy. We have chosen and started the way of doing it is in our 4 option package, which essentially every competitor, after they saw us trade it this way, this has become industry standard, right? Which, by the way, it's like the best, to tell you the best form of flattery is imitation. You're like, wow, we created industry standard. So the way we constructed is 4 options. We get our exposure by buying, and I'm going to use S&P as an example, just so it's just easier. So the strategy would be, we buy almost a low strike to almost a penny strike call on, let's say SPY, the S&P ETF, right? Now, by doing so, we get the exposure to SPY because why? Call gives you all the upside, right? But if you're striking at close to 0, then you're basically getting all the upside. Some people ask why 0? Like why don't you just strike it at 0? It becomes it no longer becomes a security. It almost becomes like a future. There's a legal aspect to that, right? So by putting in a low strike, you get the exposure. And a lot of times people ask, like, why not just buy SPY or buy S&P? There are 2 issues with that. Number 1 is I don't want to pay the expense ratio. Number 2 is I don't want to get the dividend distributed. By the way, I don't lose the economics of the dividend because typically a penny strike call will discount to the implied dividend. Meaning, like if we think S&P is going to pay 2%, then the penny should trade somewhere around 98. So it's almost like getting the dividend as a 0, right? But this creates 2 things. Number 1 is it makes it more tax efficient because why? If you spit out the dividend, gets taxed, gets kicked back in. Also allows to bake the dividend inside the strategy itself. So that gives you the exposure. A penny strike call, we buy put at 100%. That starts the protection. And if it's 10 buffer, we sell put at 90%. That's it. Starts protection 100, sell one at 90, ends the protection. That's how you create the buffer. And then you solve for the cover call, where to sell the call to pay for the protection. So this is why higher volatility, higher interest rates, because higher vol means that the call can be sold at a higher strike, right? Higher interest rates, call options, premiums go up with interest rates. So that means I could sell at a higher strike.
Yeah. And so then obviously at the 1-year time frame, then you just repeat that process again when it rolls. Is that right?
That's right.
Okay. How do you think in terms of impact, these things have grown a lot, but you're obviously dealing with, I think, the most liquid portion of the options market here. I mean, is there any sign that these have any market impact, or is that something you'd worry about as if they continue to expand and grow?
Yeah. I mean, 3 points I'll make there. Point 1 is that, that the options space, so S&P and S&P ETF options trade about about $1 trillion in notional a day. So there's definitely plenty of depth in the marketplace. The other thing is the exchange traded listed market is actually the tip of the iceberg of the derivative market, right? Meaning it's only the stuff that we see. Like most institutionals trade over the counter, right? Like if a bank is trading with another bank, they're not going to cross on the exchange. They really have no purpose of that. So there's much more liquidity that is tapped that we don't see on the exchanges, right? Think about annuities, the buffer notes, all of those options are trading not on the exchange, most likely. They're probably all happening over the counter, right? And like I said before, just annuities alone sold 50 billion in buffers last year. So that's new trades that are coming in over the counter that's happening. So that's point one. Point two is that there's a lot of kind of misconception that when I am buying an option, someone is selling me the option. Like there's another person out the back. So typically on a trading desk, if I'm selling you the option, I'm going to sell you the option, but then I'm going to delta hedge with the stock, right? So meaning I'm the trader, but I'll sell you the option, but I'll just delta hedge with the stock. And so it really, from a delta perspective, the capacity is how easily can I access the stock per se, as opposed to the actual. Now, there are concerns as far as like volatility, let's say like things such as like volatility risk that a counterparty would have to hold. And those are typically offloaded in other parts of the bank, right? Like typically, if I were to simplistically say like from a micro level, let's say buffer or hedging strategies are long volatility and like auto-callable strategies are short volatility, right? So if I'm a bank and everybody wants buffers, then I'll price my other side, my auto-callables better to create more interest. So my risk book kind of balances, right? Does that make sense? That
Yes.
you're constantly pricing one to the other to create balance to essentially your risk book moving one side to the other. So there's always this idea that like vol and options are very fungible when you think about it. It's like, hey, I sell you the option, I'll long or short the stock to hedge myself, and then I'll offload the volatility if I need to, or house it myself. So that's point two. So think about it. First off, it's only the tip of the iceberg, right? There's a huge market underneath. The actual creation of them is driven by what? The ability to source the hedges and offload the risk and the balance in the market. And then the last is an example. I think there's I'm not going to name names, but there's a fund that was a hedged fund that also had a put spread collar. I think it went to like 30 billion and it was rolling 30 billion in one day, right? If I had a single buffer ETF at 30 billion, I would not be on this podcast. I would be on the beach. Like if our buffer ETFs, one of them got to 30 and I had to trade all 30 billion in one day, yeah, it would be a very good problem to have. I'm nowhere close. We're nowhere close to having a single fund at that level. But my point is we've already seen that happen, and like not like the world didn't end at that point, right?
How do you mostly see these being used, like in the context of the overall asset allocation in portfolio? Like, are people using these as like for their core equity, or is it kind of a core satellite approach? Or I'm sure you see the whole wide gamut of things, but just how, like, what's more common for you to see as you talk to your people that are invested in this?
Yeah. So the three, and the first one is probably the most, is the strategic investor. They're going into what I said about diversifying your risk management. They're hedging, right? And the most cases, like I said, the foundation of asset allocation diversification is don't put all your eggs in one basket. When my stocks go down, I hope my bonds go up, right? That's kind of the premise. We're not saying that that's dead or broken. We're just saying that like during times of inflation or getting creative and diversifying your risk management, you pull from both. So like as an example, this is just let's say I had a 60-40 portfolio and I take $10 out, take 6 from equity, 4 from fixed income. The vol of the portfolio would largely be the same if you look at the historical data, right, of the index. But the source of your risk management has changed, right? You're actually hedging to keep the vol down as opposed to just moving from bonds to stocks. And this is why, like, I think one of the biggest issues I think with target date funds, what happened in 2022 with target date funds? As investors were getting older and they're ramping, you put them into fixed income, like literally out of the frying pan into the fire in 2022. As they're getting older, you're supposed to reduce their risk, but they're increasing duration while rates are going up because they're brainlessly doing it. Well, let me ask you this. If I change that paradigm, and we wrote a paper on this, is instead of doing that, why don't I just increase, if I am in my 30s, I have a 10 buffer. As I get older, I start mixing in 15s. I start adding 25s. And then when I'm at retired, I'm at hundreds, like 100 or max, right? I'm mixing it. I'm increasing my hedge as I get older, not adding duration risk as I get older. This is the key thing that I'm saying is like why the top reason of people looking at it is diversifying their risk management, rethinking it, doing what the institutionals are doing, hedging, right? We didn't invent this. Like I said in the beginning, it's just an easier way to introduce hedging into the portfolio as the source of your risk management, because you got to get creative in a world where inflation, could rear its head, whether through tariffs, geopolitical risks. I could go on and on as those types of issues. So that's the first. Number two, it's a different way to reduce volatility and equity exposure in the portfolio. So there are two ways. There are actually several different ways, but let me tell you like the traditional ways. They would go invest in low vol stocks to reduce the volatility, right? By the way, low vol stocks massively underperformed the S&P during COVID. Like when they were supposed to save you, they were the ones that burned you, right? Because it was primarily tech and the hyper growers that did really well during COVID, right? The tech ones, which low vol strategies didn't really have those, right? So volatility is not constant. So that's one. Second is just selling equity, right? Reducing your position. This is an alternative to that. You can actually keep your equity exposure, hedge it, and then limit some of your upside. So that would be an alternative as a way to reduce beta if people want to be more defensive in the marketplace. And then the third is obviously like you said, like a behavioral finance, like tactical. There are investors that are a little bit nervous to help with that process. Keep them invested. Because one of the biggest things of financial advisors, their value add is actually keeping their investors and their clients invested, right? And staying in the market.
I want to ask you about the other side. Whenever we talk about any investment strategies, we always like to look at both sides of it. And there has been some papers recently that sort of compared them to, I would say, other methods of hedging, like certain percentages of cash and stock. Or, you mentioned inflation before, and some people would say, well, I can just buy gold and add that to my portfolio, and that'll help me with inflation. So how do you think about these compared to maybe some of these other ways you could potentially hedge a portfolio?
Yeah. That's a good question. So two things. Number one, I'll address the commodity one first. I think commodities are great for hedging inflation. I think I am, me personally, terrible at timing the trade, right? People crushed it in 2022 in commodities. They did very, very well. But then they got later on, if they held on to it, right, it came like roaring back down. It does. I think gold, all of those do really, really well during times of inflation. I'm just not good enough to time it on like when to get in and when to get out. Or if you just sit in it over the long term, like things such as commodities, they're not giving you the return like over the long term, right? But like I said, are they great? Yes. Can I time it? Maybe somebody else can. I'm not good at that, right? On the second point, as far as some of the critiques out there as far as like cash and equities, I think the key here is that cash and equities, you have to know what the beta is, how much cash, how much equity to actually hold, right? That's number one. The problem is what you're determining, if you're going to compare against a buffer ETF, the beta is unstable. Like the beta reduces, when we look at, let's say, options, the delta falls when it's in the buffer zone, increases as it's in the up zone. So think about it. It's like the vol reduces as it goes down, the vol increases as it goes up. And so it's asymmetrical on how it is. So the first thing is things such as Sharpe ratio, and this is academic. Like if you actually just Google it, is Sharpe ratio appropriate for evaluating option strategies? The answer is a hard no, right? Because these are asymmetrical strategies and standard deviation is symmetrical. So number two is that in order to know the beta, if the beta is unstable, how much cash are you going to, how much cash, how much equity do you know? You only know it via hindsight, right? You wouldn't know if I asked you right now what beta to use on any one of my buffers right now. That beta is not going to be the same, most likely in a year, 2 years from now. So how do you know? You have the benefit of hindsight. The second is when you're doing these types of analysis, you have to actually doing it, comparing a hypothetical to an actual fund. There are a lot of things that you don't realize until you actually run the particular strategy, right? Like as an example, there's tax on your cash position. There's tax on rebalancing, right? If you don't rebalance a 60-40 cash in 5 years, it's going to be 98% equity. Of course, it's going to outperform a buffer. You're basically on just long equities only, right? So, and then what is the frequency of the rebalance? All of those things. And then what's the tax consequences of the rebalance? Trading costs, all of those, right? And that's where it all comes in that when you actually run the strategy. And here's the big thing is that how many people would actually pay to be, if I give you $100, $60 in equity, and I'll put your other $40 in cash, and I'm going to charge you a fee on the entire amount. Like, or how many people would actually want to do it themselves to rebalance every month, every quarter, buy the treasuries, trade them, everything? I'm not sure. This is the anti-version of what I said in the beginning of this was about making it easy, bagging apples, right? This is the exact opposite of everything that I believe is because, look, number one is if you're going to do it, do it. Number two is if you're going to do it, that's an extremely hard task to actually, I mean, I invite people to do it. And so that's one thing that I think is and people, and by the way, people have tried this in the past, right? Managed vol strategies, combining equity and cash, and they got wildly crushed, during whipsaw markets because they're targeting a particular vol. But obviously if you have it with hindsight, yeah, you can make you can do this. Honestly, the cash to beta, cash to equity with any strategy actually. And you can almost make it like you can make it win. Like in some cases, just leveraging at treasuries, right? And then you can do the same thing.
And your beta point was interesting because the experienced beta of these is going to vary a lot, right? Like if I do a 15% buffer, depending on when that thing launches and depending on, if it stays in the buffer zone or if it goes outside of the buffer zone, any given one of these is going to have a very different experience beta in the real world, depending on market conditions.
Absolutely. And you know what's entertaining to me is this. Like I said, buffer notes have been around, annuities have been around, put spread collar has been around for over 3 decades. Why the sudden critique of something that's been around for 30 years? Because people get sensitive when the assets start coming from you. Then suddenly it's like, okay, let me create this hypothetical to try to shoot this down. But look, I'm not going to be the only one, nor should I be the only one defending this, because the end of the day is like, I don't know, maybe the insurance companies and the banks should probably come in and defend the same strategy that we're just doing in ETFs. But no one's been doing that in the past because suddenly now it's like eating someone else's lunch.
Just one more critique I want to talk about. This is more of a critique of all option strategies rather than this in general, but this idea that obviously Ken Griffin has yachts for a reason. And, when you're using options repeatedly over and over, there's a cost associated with that. Sure. And that cost will be drag on returns over time. How do you think about that?
Yeah, so this is a good question. So I agree with the statement that if I buy S&P and I'm buying S&P put, and I buy it over and over and over and over again, it's like buying car insurance, right? Like you don't intend to win on your car insurance trade, right? I hope not.
Yeah, not except bad
situations. You don't intend to win on your life insurance, like the life insurance trade, you win on that, probably not the best thing. But the idea, like definitely car insurance, you're not looking to win that trade, right? Correct. So like that's the same concept. But let me ask you this though. In the strategy that I talked about, I bought a put at 100%. I sold a put at 90, and then I sold a put at let's say 115 or something. By the way, the call that I bought at the bottom, that's just like buying SPY. That's not really an option per se. But let me ask you this. How many options did I sell and how many did I buy? I sold 2. I bought 1. Right? So am I long or am I short ball? I'm actually, and think about this for a moment. I just told you that if volatility goes up, the cap is higher. And by the way, if volatility goes up, the pricing goes, not the pricing, but the value of the option package will fall in normal situations. So that means that are you long or are you short volatility? Because you're short 2 options, you're long 1, right?
Right.
That's the question. by the way, if you're long volatility, if volatility goes up, the value goes up, right? In this case, vol goes up, the value falls. So you're actually short volatility in this trade. Now let me add, so then take it back to that point. The point is if you buy options, you're going to lose over the long term. But what happens when you sell them? Right? That's my question. Because it's all like people that don't understand, they have this criticism before they even realize, and this is like, I'm not naming any names. They don't realize that it's actually short two options, long one. Net, it's short vol. This is why when vol goes up, the package goes down, because otherwise, if you're long vol, like if you buy a put, vol goes up, the put goes up in value. Agree? That's the point that they're making. That is not the case with this situation, right?
How much of the advantage of these is behavioral? Because one of the things I was thinking about, I'm a quant guy, so I build quant strategies. And one of the things I've learned over the course of my career is sometimes I can build a strategy that maybe has better statistics on my spreadsheet, but it does much worse in the real world because investors can't stick with it. And I'm wondering, like, is that one of the big benefits here of this? Is we're talking about, oh, maybe you could hedge in different ways, but if people really believe in this concept, are they going to get better real world outcomes this way than they might get in maybe some other hedging type strategies? Do you think there's validity to that?
I think so, but I don't think it's the primary. I think the quant numbers also support, but I do agree with you. It does play a significant, it's significant for end investors because, like, let's say, like, typical investor underperforms the market by 2% because of their own actions, right? That does help. But I am also a believer of the numbers as well.
What are some other, as you look to the future, but also some things you're maybe doing now besides these, what are some other ways you've taken this concept and expanded it into different products or different areas or internationally or other things like that?
Yeah, so you'll see the overall trends coming now that, like, there's a couple of providers out there that have already started on auto call type funds. So other parts of the structured note market is going to come. I think you'll see more and more parts of option-based strategies that we've seen in the structured space come into fund form one way or another. I think that, and then that will spawn a whole new level of, it's not just different buffer levels, different terms, but also going horizontally, different underlyings. Like you've seen the ones in crypto, the ones in gold, and then even, like, other providers have provided buffers on their own strategies, right? The horizontal and vertical part of it is endless. And then as you go into other types of terms, right? Like, let's say, things such as like dual directionals, auto callables, all of those then have the same horizontal effect of other underlyings, other things that are coming out, right? I think we are only in the third inning here, right? And I strongly believe this. And you probably saw a couple months ago, BlackRock wrote the article that this space is going to be 600 billion by 2030, right? Which is not too outrageous when you think about a buffer annuity sold 50 billion, almost 50 billion in assets in 1 year, new money in 1 year, right? It doesn't seem too outrageous considering how big the structured note market is, the option market, and where the growth can actually occur. I could tell you, it's like that moment when you feel like you're in the exactly where you want to be. It's that.
Yep.
Like, the only like more exciting place would be, I don't know, making Skynet and AI in Silicon Valley. At least under my brother's doing that. I'm just stick to finance.
How do you think about the ability to apply something like this to something like Bitcoin, like these higher vol assets? Is this a play? Can these types of funds? I mean, they may already, and I'm just not educated on it.
We have strategies in that. I think it's great. I think the reason.
What are some of the challenges of that, like for a Bitcoin type asset?
Let me address the first one, then I'll go into the challenge.
Okay.
First thing is Bitcoin is extremely volatile. So being able to hedge that can make it more appropriate for investors that may not be able to stomach a 80% max drawdown, right? The second is the vol is really high. So it's also a great way to can be a good way to generate income, depending on your risk return tolerances, by, selling vol by, like, let's say writing cover calls or certain things like that can be a good way to generate income because typically you generate more premium from things with higher volatility. So those are two things extremely attractive. When you marry crypto and options together, options can help to target the risk return that you're looking and also generate yield given that it's high volatility. The challenges with crypto, I would say a lot of it is regulatory. It's like the lack of transparency in the regulatory interpretations, right? There's constantly always like new things coming out. So you don't, it's hard to, two people can look at the same thing and come out with different rulings as far as like thinking of like how one versus the other. So there's still a little bit like the industry needs to, I think everybody needs to come to consensus on what is the interpretation. And we're starting to see that, right? Like there's certain rulings that are coming out that like, hey, where crypto is. So that's one of the things associated with that. The second is, and I'm talking about from a build perspective, is obviously like how to put it inside a fund. Like, does it require a Cayman structure? Does it not? Like there's a lot of like nuances associated from the build perspective. And then from the investment perspective is obviously, making sure that it's appropriate, suitable, the right strategy for a particular client.
So thank you so much. We really appreciate your time. As we wrap up here, we have two standard closing questions, which don't have to relate to buffer ETFs at all, or they can. But our first one is, what is one thing you believe about investing that most of your peers would disagree with?
One thing in investing that most of my peers would disagree with. So as I actually used to, as a former mortgage trader, I used to trade agency mortgages. I think that fixed income as an asset class is fantastic, but I think it requires leverage in the context of where equity returns have been. And there have been a couple papers on this as far as that, that getting into fixed income to enhance the return, some level of leverage is I believe, in a portfolio, probably more beneficial. And that's probably more controversial than, maybe you're a normal person that's just buying bonds and stocks.
That's great. And our last one is, based on your experience in markets, if you could teach one lesson to the average investor, what would it be?
For the average investor, stay invested, right? Especially if you're investing for retirement, couple of rules that I would say. Number one is to stay invested. Number two, never FOMO. Like never. Like let someone else make their money, but do it like methodically in your own way. And then unless you're a Warren Buffett, you should not be picking individual stocks. Like you probably, you don't have that edge. If you actually see all the people that are actually like these shops and the amount of people that are looking at every single name, it starts to question, like they're doing that full time. And I would say that like similar is that individual stocks, the ability to pick the winners, I think is a little bit delusional if you think you're going to beat the S&P, given that, I think it's like 92% of large cap managers underperform the S&P over a 20-year period.
Well, thank you. We really appreciate your time. Thank you for joining us.
No, absolutely. Good to be here. Thanks, Chang.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.